In this video, we will analyze the financial statement of Mrs. Suman Limited with the help of ratios. So let's start. The first thing that we should do is we will have to read the problem carefully. The following balances appear in the books of Mrs. Suman Limited for the year ended 31st March 2018. You are required to prepare revenue statement and balance sheet in vertical form. Calculate balance sheet ratio, revenue statement ratio, and composite ratio. So we have equity share capital 2,25,000, plant and machinery 45,000, purchases 6,55,000, sales 85,000, bank overdraft 20,000, office rent 5,000, advertisement 10,000, finance expense, that is interest 8,000, income tax 15,000, preliminary expenses not yet written off 5,000, bills payable 15,000, net profit brought down from previous year 13,000, opening stock 75,000, sales commission 6,000, sales 8,55,000, debentures 50,000, interim dividend paid 15,000, depreciation 15,000, office salaries 15,000, dividend received 5,000, goodwill 25,000, land and building 48,000, creditors 25,000, trade investment 75,000, return to suppliers 5,000, debtors 65,000, cash 45,000, carriage outward 4,000. Additional information: closing stock as on 31st March 2018 is rupees 80,000. So as we know, we will have to give two effect for this particular information, or you can say adjustment. Right now, what is the first thing that we are supposed to do? We will have to prepare revenue statement and balance sheet in vertical form. Right, so let us prepare the revenue statement and balance sheet in vertical form. Okay, so this is how we prepare vertical income statement. You will start with, in the books of Mrs. Suman Limited, vertical balance sheet, vertical income statement for the year ended 31st March 2018. 4 columns: particular column, amount column, amount column, and amount column. 3 amount column and 1 particular column. First, we take sales. From that, less cost of goods sold. Then opening stock, add purchase, less closing stock, wages. So we will get gross profit. How we got this gross profit? Sales minus cost of goods sold. So this is our gross profit. What is the amount of cost of goods sold? 7,30,000. Right? Now, operating expense, we have administrative expense, office rent. Under administrative expense, we have office rent, depreciation, and office salaries. So if we say our total administrative expense is 35,000. Next is selling and distribution expense. Under that, we have advertisement, sales commission, and carriage outward. So the total of selling and distribution expense is 20,000. Now, if you want to know total operating expense, you will have to add administrative expense and selling and distribution expense. So 35 plus 20,000, you will get 55,000 as total operating expense. So now if this total operating expense is subtracted from gross profit, you will get operating profit of 70,000. right? Then to this operating profit, we will have to add non-operating income. That is dividend received. So we have added dividend received to non-operating, operating profit less non-operating expense, that is finance expense, interest, 8,000. So we got net profit before tax. So our net profit before tax is 67,000. From this we will subtract income tax 15,000. So we will get profit after tax, which is 52,000. Then add net profit of the previous year 13,000. You will get profit available for appropriation, which is 65,000. Then from this we will subtract appropriation, that is interim dividend, 15,000. So finally we will get retained earning, which is 50,000. Right? So this is how we prepare vertical income statement. Now let us go for vertical balance sheet. So the heading which you will give is vertical balance sheet as on 31st March 2018. Again 4 columns, particular, amount, amount, amount. 3 amount column and 1 particular column. We will start with sources of fund. Under this we will take owners fund. So in that we have taken share capital, equity share capital 2,25,000. Add reserves and surplus. Under that we have retained earning of 50,000, which we got from income statement. You can see income statement, that is revenue statement. We got retained earning of 50,000. So same 50,000 has been transferred here in the balance sheet under the head reserves and surplus. So once you add reserves and surplus to equity share capital, you will get 2,75,000. From this you will have to subtract preliminary expenses, that is fictitious asset, 5,000. So finally you will get 2,70,000. So what is this 2,70,000? 2,70,000 is owner's fund. To this we will add loan fund, that is debenture, 50,000. So finally you will get total sources of fund. Right? So our total sources of fund is 3,20,000. Next, application of fund. In that, the first thing that we take is fixed asset. Under that we take intangible fixed asset first. So goodwill is an intangible fixed asset. So we have taken goodwill under intangible 25,000. Then tangible, under tangible we have taken land and building 48,000, plant and machinery 45,000. So total of this is 93,000. So intangible plus tangible fixed asset will give you total fixed asset, which is 1,18,000. Right? Next, long-term investment, we have trade investment under that. So we have taken 75,000 as our trade investment. Then we have working capital. How we get working capital is current asset minus current liability. So under current asset we have taken quick asset, and that we have cash and data. So total of quick asset is 1,07,000. To this we add non-quick asset, which is inventory as per the problem. So 80,000 is inventory. We have added to non-quick. We have added this non-quick asset to quick asset. So we got total current asset as 1,87,000. Then we calculated current liability, and that we have two different types of current liability: quick liability and non-quick liability. So under quick liability we have creditor and bills payable, total of which is 40,000. And under non-quick liability we have bank overdraft, which is 20,000. So quick liability plus non-quick liability will give you total current liability 60,000. So current asset minus current liability will give you working capital of 1,27,000. So now if you see the asset side, we have three amount in the outer column. One is the fixed asset, this one, fixed asset, total of fixed asset. Then next we have long-term investment, 75,000. Then next we have working capital of 1,27,000. So if you take total, you will get total application of fund, which is 3,20,000. Now this total application of fund should match with the total sources of fund, which is 3,20,000. So that means we can say our balance sheet is tallying. Our total sources of fund is equal to total application of fund, which is 3,20,000. Right now, this was the financial statement which we have prepared in the vertical form. That is, we have prepared vertical income statement and vertical balance sheet with the help of the information which was given in the problem. Now, based on this vertical income statement and vertical balance sheet, we will have to prepare, or rather we will have to find out the ratios. So we have three different types of ratios. In that, the first one is balance sheet ratio. Second one is revenue statement ratio, and the third one is composite ratio. So let us start with balance sheet ratio first. So in that, the first ratio that we have is current ratio. The formula for current ratio is current asset upon current liabilities. So if you go to the balance sheet and check the total of current asset. So if you see, our current asset is total of current asset is 1,87,000 and total of current liability is 60,000. So it will be 1,87,000 upon 60,000, because the formula is current asset upon current liabilities. So you can see we have taken 1,70,000 here and 16,000 here. So 1,87,000 upon 60,000 will give you current ratio. So in this case, current ratio is 3.12:1. Next, quick ratio. The formula is quick asset upon quick liabilities. So let us go back to the solution, balance sheet, vertical balance sheet. We are looking for quick asset. So in this case, you can see 1,07,000 is quick asset and 40,000 is quick liability. The formula is quick asset upon quick liability. So in that case, we will take 1,07,000 as quick asset and 40,000 as quick liability. So you can check. We have taken 1,07,000 as quick asset and 40,000 as quick liability. So 1,07,000 upon 40,000 will give you 2.68:1. So in this case, the quick ratio is 2.68:1. Next balance sheet ratio is stock to working capital ratio. Formula is stock upon working capital into 100. So we want stock and working capital. Let us go back to the solution. So if you see stock, yes, you can say inventory, that is stock, is 80,000, and working capital is 1,27,000. So the formula is stock upon working capital into 100. So it will be 80,000 upon 1,27,000 into 100. So that will give you 63%. So our stock to working capital ratio is 63%. So let us go for the next balance sheet ratio. The next balance sheet ratio is proprietary ratio. The formula is proprietor's fund upon total asset into 100. So here we require two items. One, proprietor fund, and second, total asset for calculating proprietary ratio. So again, we will go to the balance sheet. So let us find out proprietor's fund. So proprietor's fund is 2,70,000. The other name for proprietor's fund is owner's fund, or you can say shareholders fund or net worth. So there are four different names given to proprietor's fund. One, proprietor fund itself. Second, owner's fund. Third, net worth. And fourth, shareholders fund. So our proprietor's fund is 2,70,000 and we are looking for total asset. Okay, so in this case, uh, we are not looking for total sources of fund or total application of fund. So you cannot say 3,20,000 as your total asset because this includes current liability. So if you want to know total asset, you will have to add only the assets. Like we will take fixed asset 1,18,000. Then we will add 75,000 into that. Then we will add current asset, that is 1,87,000. So our total asset is coming to 3,80,000. How we got this 3,80,000? Fixed asset plus investment plus current asset. We are not including current liabilities. So you can see total asset is 3,80,000, wherein total application of fund is 3,20,000. So remember this point, we have not taken total application of fund because that cannot be your total asset, right? So how we got total asset? Fixed asset plus investment plus current asset. So proprietor's fund is 2,70,000, total asset is 3,80,000. So 2,70,000 upon 380 into 100 will give you 71.05%. So in this case, proprietary ratio is 71.05%. Let us go for debt equity ratio. The formula is debt upon equity. Okay. Now, debt means long-term borrowing or borrowed fund, and equity is net worth, owner's fund, right? So let us go back to the balance sheet. Let us find out loan fund or borrowed fund. So our borrowed fund is 50,000 and equity, that is shareholders fund, because we don't have preferential capital in this, so hence we can say 2,70,000 as equity. Okay, so it will be 50,000 upon 2,70,000. So you can see debt 50,000 upon equity 2,70,000. So it is 0.19 is to 1. So now we can say in this company debt equity ratio is 0.19 is to 1. Next balance sheet ratio is capital gearing ratio. Formula is capital entitled to fixed rate of interest or dividend upon capital not entitled to fixed rate of interest or dividend. So what do you mean by capital entitled for fixed rate of interest or dividend? The capital which gets fixed rate of interest or dividend. So in that it comes preferential capital and borrowed fund. But if you see the problem or the solution which we have done, we don't have preferential capital, right? But we do have borrowed fund, and the amount of borrowed fund is 50,000. So 0 plus 50,000 will give you 50,000. So capital entitled for fixed rate of interest or dividend is 50,000, right? Wherein capital not entitled to fixed rate of interest or dividend, in that what we can take shareholders fund and preferential capital, sorry, minus preferential capital. So our shareholders fund is 2,70,000, preferential capital is 0, right? So we can say capital not entitled for fixed rate of interest or dividend is 2,70,000. So therefore capital gearing ratio is capital entitled for fixed rate of interest or dividend, which is 50,000, upon capital not entitled for fixed rate of interest or dividend, which is 2,70,000. So that comes to 0.19 is to 1. So this is how we calculate balance sheet ratios. Now let us go for revenue statement ratios. In that the first one is gross profit ratio. The formula is gross profit upon net sales into 100. Now let us go and check the gross profit of this company. So the gross profit of this organization is 1 lakh, and the net sales is 8,55,000. So the formula is gross profit upon net sales into 100. So it will be 1,25,000 upon 8,55,000 into 100. So you can see 1,25,000 upon 8,55,000 into 100, that will give you 14.62%. So the gross profit ratio of this company is 14.62%. Next, operating ratio. Formula is cost of goods sold plus operating expense upon net sales into 100. Right? So cost of goods sold, let us go and check cost of goods sold. So we can see cost of goods sold is 7,30,000 and net sales is 8,55,000. Okay, so cost of goods sold is 7,30,000 and we are looking for operating expense also. So our operating expense means total of these two, administrative and selling and distribution, is 55,000. So 7,30,000 plus 55,000 upon 8,55,000 into 100. So the values we will put in the formula: 7,30,000 plus 55,000 upon 8,55,000 into 100 will give you 91.81%. So this is our operating ratio of this company. Next is administrative expense ratio. Formula is administrative expense upon net sales into 100. Let us go and check administrative expense, the total of administrative expense. So the total of administrative expense is 35,000. So we will say 35,000 upon 8,55,000 into 100. So we have taken 35,000 upon 8,55,000 into 100. So that will give us 4.09%. So administrative expense ratio of this company is 4.09%. Next, selling and distribution expense ratio. Formula is selling and distribution expense upon net sales into 100. Let us go and check the amount of selling and distribution expense. So the total of selling and distribution expense is 20,000. So 20,000, okay, upon net sales, that is 8,55,000 into 100 will give you 2.34%. So selling and distribution expense ratio is 2.34%. Operating profit ratio. Formula is operating profit upon net sales into 100. So operating profit, so if you see, the operating profit of this company is 70,000. So we will take 70,000 upon 8,55,000, which is net sales, into 100. So that will give you 8.19%. So the operating profit ratio of this company is 8.91%. Sorry, 19%. Next is net profit ratio. Formula is net profit before tax upon net sales into 100. So let us go and check net profit before tax. So net profit before tax is 67,000. So 67,000 upon net sales, which is 8,55,000 into 100, will give us 7.84%. So the net profit ratio of this company is 7.84%. Next, stock turnover ratio. Formula is cost of goods sold upon average stock. Cost of goods sold, we have already found, it is 7,30,000. Average stock. For average stock, you need two things: opening stock and closing stock. So if you see the solution, opening stock is 75,000 and closing stock is 80,000. So opening plus closing divided by 2 will give you average stock. So 75,000 plus 80,000 upon 2 will give us average stock. So cost of goods sold is 7,30,000 upon average stock is 77,500. So that gives us 9.42 times. So stock turnover ratio is 9.42 times. Right. Next is stock velocity, that is stock holding period. So we can calculate in month or in week or in days also. Here the formula for stock velocity or stock holding period is 12 upon STR if you want to calculate in month. So we have taken 12 upon 9.42. What is 9.42? STR, stock turnover ratio, right? So 12 upon 9.42 will give you 1.27. So stock holding period is 1.27 month of this company. Same thing you can calculate in week, you will get 5.52 weeks. Next we will go for composite ratio, and that the first one is return on capital employed. Formula is profit before interest and tax upon capital employed into 100. So we want profit before interest and tax. Now if you see, we have profit before tax, so 67,000, and if we are looking for profit before interest and tax, that means we will have to add 8,000 into this. So 67,000 plus 8,000 will give you profit before interest and tax. So that is what we have taken here. 67,000 plus 8,000 is profit before interest and tax upon capital employed. Capital employed is nothing but the total sources of fund, or you can say total application of fund, which is 3,20,000. So 67,000 plus 8,000 will give you 75,000 upon 3,20,000, which is capital employed, into 100 will give you return on capital employed, which is 23.44%. Okay, the next one is return of proprietors fund. Formula is net profit after tax upon proprietors fund into 100. So let us go and check net profit after tax. So our net profit after tax is 52,000, right? And proprietors fund is 2,70,000. So 52,000 upon 2,70,000 into 100 will give you 19.26%. So return on proprietors fund is 19.26%. Next, return on equity capital. Profit available to equity shareholder upon equity shareholders fund into 100. So how we will get profit available to equity shareholder? Net profit after tax minus preference dividend. So just now we have checked our net profit after tax is 52,000. We don't have preference dividend. Upon equity shareholder fund, that is net worth or owner's fund. So that will give you 19.26%. So return on equity capital of this company is 19.26%. Next, dividend payout ratio. Formula is dividend to equity shareholder upon profit available to equity shareholder into 100. Right? So dividend to equity shareholder. Let us go and check the dividend which we have paid to the equity shareholder. You can see the dividend which is paid to the equity shareholder is 15,000. Interim dividend 15,000. So we will take 15,000 as dividend to equity shareholder upon profit available to equity shareholder. So that is what we got from here, 52,000. So 52,000 will take here into 100, that will give you 28.85%. So the dividend payout ratio of this company is 28.85%, right?